What's up, YouTube? Welcome to the Credit Plug channel where we talk about how to build credit, how to establish relationships with banks and financial institutions, and most importantly, how to get you access to high limit credit funding. If you're new to our channel or if you've been checking out our content, make sure you hit that subscribe button as well as smash the like button. It helps the YouTube algorithm get our content out to a wider audience, and we greatly appreciate the support. So a couple weeks ago, the Credit Kingpin and I were talking about different business models where you could leverage your credit to create cash flow. And one of the business models we briefly touched on was Airbnb. So in today's video, I'm gonna be covering some of the basic information that you need to understand when it comes to real estate investment financing. So that's financing for short-term rentals, vacation rentals, and Airbnbs. We're going to be going over some of the basic information. And in a separate video, we're going to be covering some specific lenders that can fund your Airbnb vacation rental or short-term rental property. Anyways, let's go jump over to the presentation and I'm gonna walk you through some basic fundamental information that you need to know when it comes to real estate investment financing. All right, so when it comes to investment real estate financing, one of the things you have to understand is what's called DSCR, which stands for debt service coverage ratio. Now, this is a ratio between the monthly rental income of a real estate investment property divided by the total costs for servicing that particular real estate investment property with respect to your monthly payments towards the mortgage. So it includes principal, interest, taxes, and insurance. Now, with some areas there might actually be an HOA, so you include association fees. So these are going to be all the required fees and costs of actually having that particular property. So it's referred to as PITIA. So basically, in this example, we have a monthly rent of 1,800, and then the monthly costs of the property, including the principal and interest on the mortgage, the taxes, insurance, association fees, is $1,200. So the ratio is 1.5. Now, the reason why debt service coverage ratio is important is because they're evaluating each property by the DSCR, right? So it has to hit a certain ratio. So, like in this example, after all expenses, you still have about $600 left over. There has to be a certain level of cushion in order for the deal to really make sense, right? Because most lenders, they're going to want to see a DSCR of at least 1. In some of the lenders that we've actually have relationships with, they're looking around a 1.2 DSCR, meaning that earning about 20% more than what it's costing you in terms of, mortgage expense, the insurance, association taxes, and all of that. It's just basically a ratio. And these are all things that you can't really avoid, right? You have to have a homeowner's insurance, you have to pay taxes, and you have to pay the mortgage. So these are all like the required fees. Now, this doesn't include like, cable or utilities or anything like that. This is just basically for servicing the debt. That's why it's called debt service coverage. Now, we talked about this on the other slide. There's several different acronyms for this, PITI or PITIA. All right, so here I have a chart that shows interest rates based on credit score and loan to value for residential and vacation rental investment properties. Now, before I go over this, I just wanted to say that these interest rates are for illustration purposes only. Do not take these at face value. It is in line with some of the lenders that we actually work with personally, but it's for illustration purposes. So I don't want you guys to see this and say, oh, hey, Credit Plug said if I had a 740 and I put down 20%, I can get 5.975 interest rate. That's not what we're saying. This is for illustration purposes. But basically, what this chart shows is what interest rate you'll be paying based on your credit score and the loan to value. So how much you're actually putting down. You see like these boxes down here are blank. These are people at the lower credit score range. So if you have a 680, even though you can get financing with the 680, you're not going to get 80% LTV. You're not even going to get 75% LTV. The highest you're going to get with a 680 to a 699 is 70% LTV, meaning that you're going to be putting down 30%. So in order to really maximize real estate investment financing, you're going to want your credit score to be as high as possible, preferably over a 740 to get the lowest rate. But you could actually see as you put down a bigger down payment, the interest rate actually goes down. So like if you're putting down 40% and your credit score is over a 740, in this illustration, you'd be paying a 5.1. But if you wanted to only put down 20%, which is at 80% LTV, then you'd be paying 5.975. And this is before adjustments, which I'll show in a couple slides. So you could kind of figure out what interest rate you'd be paying. In mortgage lending, they're generally going to be going based off off of your middle mortgage FICO score. So whatever FICO score is in the middle, like you have your highest, your lowest, whichever one is in the middle is what they're going to be using to base the interest rate that you receive. All right, so this page right here shows interest rate adjustments. So there are certain adjustments depending on the structure of the loan. So if you do a 5/1 adjustable rate mortgage, there's no rate adjustments. If you do a 30-year fix, it's a 0.2 interest rate increase. If you want to pay a higher origination fee, you actually get an interest rate reduction, right? So if you're paying 4% of whatever the purchase price as an origination fee, then they'll reduce your interest rate by 0.65%. And then also the loan size. Now, this might seem a little counterintuitive. So 0.25 increase for properties over 700,000. Now, the reason why is because there's just more risk when it comes to higher valued properties. Anything between 200 to 699, there's no interest rate adjustment. So this is kind of like a sweet spot. And then you actually see interest rate adjustments increase with smaller loan amounts. Now, the reason why is because from a lender's perspective, it's going to be the same processing, same paperwork, whether it's a $100,000 loan or a $700,000 loan. With a lower amount in terms of what they're financing, that means it's less profit potential for the lender. So to adjust for that, they're going to increase the rates for lower value property. So to really be in that sweet spot, want to be between 200 and 699. So they also have other types of interest rate adjustments. I'm not going to get into all of these. Some of the other ones include the program type, whether it's a refinance, short-term rental property versus a long-term rental property. So a long-term rental property would be like someone who signs a year lease or a 2-year lease. A short-term rental property would be like an Airbnb or something like that. The rate that you see on the other page when it shows your credit score and the LTV, that's kind of like the base rate, but then there can be additional adjustments depending on the specifics of your particular deal or your property. It could either increase it or it could stay the same. So I just wanted to show you guys this as well. This is something that you can expect if you're working with different private lenders. All right, so this is just some basic borrower requirements. Now, this can vary from lender to lender. And then a lot of lenders require 6-month PITIA net of down payment and closing costs. Now, what this basically means is that they want to see some reserves in your bank account. So aside from your 20% or whatever down payment, you're also going to have to show some liquid assets, meaning that they want to see that, after you put down your down payment and closing, that you don't just run out of money in default on the loan. So they want to see, okay, you have at least 6 months of reserves. As we went over in the other slide, the PITIA, which is the principal, interest, taxes, insurance, and association, they want to see you have 6 months of mortgage payments basically stacked up in order to bless the loan. So they want to make sure you don't just go broke right after they give you the loan. And then with credit, right, they're looking at your middle score, usually your middle FICO score. Some lenders might have different requirements in terms of the number of active trade lines, usually 2 trade lines for at least 1 year. We'll go over some specific lenders that have slightly different programs. They're going to want 6 months of reserves stacked up, and they're looking at your middle FICO mortgage scores. Now, the property requirements can vary. Now, I took this from one of the lenders that we actually work with, a 1 to 4 unit family residential townhouse or condo. Some lenders might have minimum property values, meaning that they don't want to lend under a certain amount. And then property condition, usually for vacation rentals, this is going to be for move-in ready kind of turnkey properties. This isn't going to be for fixing and flipping type of financing. That would be more so of like a hard money lender. This is actually looking for turnkey properties. And the DSCR, as we went over for this particular lender, 1.2. So let's say it's $1,000 a month PITIA and the rental income is $1,200. So that particular property would meet the DSCR, the debt service coverage ratio requirement. The property must be rent ready. So lastly, I wanted to go over some of the benefits of private real estate financing. A lot of it you can get without employment verification, without income verification, no debt to income calculations. Now that's huge because when you're applying for a mortgage where you're actually going to be living in an owner occupied residence, they're going to be looking at your debt to income calculation, what debt you have and what your income is. They might want to see tax returns. So it's a little bit more thorough vetting and documentation when it comes to an owner occupied occupied type of property. But with a lot of private real estate financing, they don't really care about your debt to income. They're looking at the particular deal, right? So how much rental income is it going to produce? Do you have the down payment? Do you have some funds in reserve? And do you have a decent credit score, right? Most of them aren't going to ask for tax returns or 4506T, which is a tax transcript verification. Some lenders don't care about the seasoning of funds or the sourcing of it. So that's another advantage. And then most of them are going to be a minimum 680. But remember, 680 isn't going to get you the lowest rate, nor is it going to give you the highest LTV. You want the highest LTV as possible. With a 680, some lenders, they're probably going to only give you a max of maybe 75 or 70% LTV, meaning you're going to have to put down a larger down payment. All right, so let's recap some of the key takeaways when it comes to real estate investment financing for short-term rentals, Airbnbs, and vacation rentals. But before we get into that, I just wanted to state that we are not real estate experts. We're just giving you information based on our personal experience and understanding. Some key takeaways you want to be mindful of is, in order to get the highest loan to value and the lowest interest rate, you want your middle mortgage FICO score to be above a 740. And you're going to want to make sure that the DSCR, which is the debt service coverage ratio, meets the lender's requirements. So again, the debt service coverage ratio is the rental income divided by the cost of servicing the mortgage on that particular property, and it has to meet a certain ratio. So most lenders that we work with, it's 1.2. So if the rental income is $1,200, the cost of servicing the debt is $1,000, then it meets the requirement. In addition, you also want to make sure that you have cash reserves of at least 6 months PITIA, principal, interest, taxes, insurance, and association. So aside from having the 20% or whatever down payment you're putting down plus closing costs, you also have to show that you have cash reserves in order to make at least the first 6 months of payments in case anything happens. If you don't get a tenant, or if no one rents out your property, you basically want to have that set aside just in case. Now, some of the benefits when it comes to real estate investment financing, unlike with traditional mortgage financing, is that debt to income is usually not going to be a factor, right? And sometimes they don't even do income verification. They're not 4506T'ing you or asking for tax returns or anything like that. As long as you meet the credit requirement, you have the down payment and closing costs, you have 6 months reserve, and the DSCR meets the requirement of the underwriter, then it's pretty straightforward from there. So we will be going over specific lenders where you could go to get funding for your Airbnb vacation rental property. So that's all I wanted to cover in today's video. Until next time, y'all take it easy, and we'll talk to you soon. Peace.